An Australian couple can have $107,328 a year coming in and still get paid the age pension. For a single person, the figure is $70,236 a year. Those aren't typos, and they're not loopholes. They're the published income test cutoffs. And almost every Australian I hear from is convinced that earning anything at all will cost them their pension. So they either don't apply or they turn down work they genuinely like to do. Let's go through what you are actually allowed to have coming in. Before we start, hit subscribe and tell me in the comments which state you are watching from. It helps me know what to cover next. An assets test and an income test. Centrelink runs both, calculates what you'd get under each, and pays you whichever result is lower. I covered the assets test in detail recently. This video is entirely about the other one, the income test, because it's the one that stops people working and the one people understand least. Start with the full pension figures, because these are the numbers most people have vaguely heard, and they're the source of all the confusion. To receive the maximum rate, a single person can have income up to $226 a fortnight. For a couple, it's $396 a fortnight combined. Those are small numbers, about $5,800 a year single, or $10,300 a year for a couple. And that's where most people stop reading, conclude the pension isn't for anyone with income, and never look further. But that figure isn't the limit. It's the point where your payment starts to reduce, and it reduces gently. Above that threshold, your pension drops by 50 cents for every dollar of income. 50 cents in the dollar, not dollar for dollar. So a single person with $400 a fortnight coming in is $174 over the threshold, which reduces their pension by $87 a fortnight. They don't lose the pension, they lose $87 of it and keep the rest, and keep the concession card. Follow that slope far enough and you reach the number that opens this video, the cutoff, where the payment finally hits zero. For a single person, that's around $2,700 a fortnight, the figure being confirmed at $2,701.40 from the 20th of September. For a couple, it's $4,128 a fortnight combined. Multiply those out across 26 fortnights and you get $70,236 a year for a single person and $107,328 a year for a couple. Anywhere below those numbers, there is some pension payable. Now, I want to be straight with you about what that actually means, because a number that large deserves an honest caveat. At the very top of that range, you are receiving almost nothing, a few dollars a fortnight. The value of being just under the cutoff isn't the payment, it's the pensioner concession card that comes with it, which is worth real money every year on medicines, council rates, energy, registration and transport. For a lot of people near the top of that slope, the card is the entire reason to claim. The large fortnightly payments live down at the bottom of the range, not the top. Both things are true. The cutoff really is over $100,000 for a couple, and the money at that point is small. Now, the part that matters most, if you're still doing any paid work, because this is where people leave the most on the table, the work bonus. The first $300 a fortnight of employment income is not counted under the income test at all. Not reduced, not counted. That sits on top of the ordinary threshold, so a single person can earn $300 a fortnight from a job and still have their full $226 allowance underneath it before anything starts to taper. And the work bonus does something most people have never been told. It banks. Every fortnight you don't use that $300. The unused amount accumulates in a work bonus income bank, building up to a maximum of $11,800. On top of that, new pensioners start with a $4,000 credit already sitting in the account from day one. Picture someone who retired 18 months ago and hasn't worked since. Without doing anything at all, they could be sitting on many thousands of dollars in that bank. If they then take a seasonal job, a few busy months, well over $300 a fortnight, the bank absorbs that income before the income test touches their pension at all. That's the mechanism that lets a pensioner work hard for a short stretch without their payment moving. And it only applies to employment income, so it's genuinely about work, not investments. Here's the piece that catches people out, And it's the reason your income test result may look nothing like your actual income. Most retirees' assessed income isn't earned at all, it's deemed. Centrelink doesn't count what your savings genuinely paid you. It assumes a rate of return and counts that assumed figure. Currently, that's 1.25% on financial assets, up to $66,800 for a single person, or $110,600 for a couple combined, and 3.25% on everything above. So somebody with no job and no earnings at all still has assessed income under this test, generated entirely by their bank accounts, term deposits, shares and account-based pensions. That's usually the bulk of the number, and it's why people who don't earn anything can still be reduced under the income test. It's worth knowing what counts and what doesn't, because assumptions here cost people money in both directions. Employment income counts, subject to the work bonus. Deemed income from financial assets counts. Rental income from an investment property counts. Income from most annuities and account-based pensions counts, though some lifetime income streams get concessional treatment where only 60% is assessed. What does not count, money you withdraw from your own super as a lump sum, is not income. The balance is assessed as an asset instead, but taking money out doesn't create an income hit. And your family home is irrelevant here entirely. Now, two questions come up every single time I cover this, so let's deal with both properly. The first is about couples with an age gap, and it catches people badly. If you're partnered, the income test assesses your income as a couple, combined, even if only one of you has reached age pension age. Your partner doesn't have to be old enough to claim for their income to count against you. So if you're 68 and claiming, and your partner is 62 and still working full-time, their salary counts toward that combined figure. Picture someone who reaches pension age, applies, and is genuinely shocked to be knocked back or heavily reduced because of a spouse's wage. Nothing has gone wrong. That's how the test is built. The age test applies to each of you individually, but the means tests apply to the household. The flip side is worth knowing too. When that younger partner eventually stops working, the household income drops and the pension can rise substantially without anyone doing anything. If your partner is about to retire, that's a moment to recheck your entitlement rather than assume last year's answer still holds. The second question is about one-off money, an inheritance, a redundancy payout, the proceeds of selling something, a gift from family. Here's the key distinction, and it's genuinely good news. A lump sum like an inheritance is not treated as income. It doesn't get counted under the income test as a huge one-fortnight spike that wipes out your pension. What happens instead is that once the money is in your hands, it becomes an asset, so it's assessed under the assets test, and it's deemed to be earning income from that point forward at the standard deeming rates. Same for a lump sum you withdraw from your own super. So the fear that inheriting money will destroy your pension in the fortnight it lands is misplaced. The real effect is slower and smaller. Your assets go up, deemed income goes up, and your payment adjusts accordingly. What you must do is tell Services Australia, and generally within 14 days of the change. Not reporting it doesn't hide it. It creates a debt that gets recovered later, usually with more pain than if you'd simply reported it at the time. Here's the trap where the two tests collide, and it's the single most misunderstood thing about the whole system. You must pass both, and whichever produces the lower payment is the one you get. So there's no point celebrating that you're comfortably under the income cutoff if your assets put you over on the other side. Picture someone with modest income but $900,000 in assets outside the home. The income test might suggest a healthy pension, but the assets test result is lower, so the assets test is what they get. Most people who are surprised by their assessment have been looking at one test while the other one was setting their payment. Let me put it together with a realistic example. Take a couple, both 68, who own their home. One of them still does 2 shifts a week at a local business, bringing in $500 a fortnight. They have $300,000 in financial assets between them. The work bonus takes $300 off that employment income straight away, leaving $200 counted. Their financial assets are deemed, the first $110,600 at 1.25%, the remaining balance at 3.25%, producing somewhere around $280 a fortnight in assessed income. Add the counted employment income, and they're at roughly $480 a fortnight. Their full pension threshold is $396, so they're about $84 over, which at 50 cents in the dollar reduces their combined pension by around $42 a fortnight. They keep almost the entire pension. They keep both concession cards, and one of them keeps working 2 shifts a week. If they'd assumed that job would cost them the pension, they'd have given it up for nothing. So here's what to actually do. If you're working or thinking about it, find out what's sitting in your work bonus income bank before you turn anything down. It's often thousands, and it's the difference between a job costing you money and costing you nothing. If you're not working, understand that your assessed income is mostly deemed from your savings, so it moves when deeming rates or your balances move, not when you do. Check both tests rather than one, because the lower result is the one that counts. And if you were told years ago that your income was too high, treat that as expired. These thresholds are indexed regularly, and the cut-offs move upward, so an answer from a previous year may simply no longer be true. 2 honest notes before you go. First, these figures are current as published, and the income test thresholds are indexed regularly. The single cut-off is being confirmed at the new figure from the 20th of September. So verify the exact current numbers with Services Australia or through MyGov, rather than relying on any figure quoted in a video. Second, this is general information, not personal advice. Your own result depends on your income type, your assets, your relationship status, and your work situation. So take your real numbers to Services Australia or a licensed financial advisor before making decisions about working or claiming. So tell me in the comments, did you think earning anything would cost you the pension? And if you've turned down work because of that belief, I'd genuinely like to know. Take care, and I'll see you in the next one.